Hey friends, I'm back with another dividend stock investing video. In the video today, I look forward to covering 5 different dividend stocks that I personally own in my stock portfolio. I rely on these stocks to pay passive income that I can use to pay my bills. I got the props today. One of the stocks I'm going to cover is Clorox. Check it out. Got the huge Clorox wipes here from Costco. But quite frankly, who really cares about this prop right now when there is some pretty awful news out there on the TV right now? Just today, Silicon Valley Bank failed. This is the second largest bank failure in United States history. Check it out on the screen right now. You can see in front of you how Silicon Valley Bank has failed and the FDIC right now is taking over control. The regulators are taking over control. To my understanding, what happened with this bank is there was basically a run on the bank and the bank was trying to sell off assets, but a lot of these assets are underwater right now because they were holding treasury bonds, for example, that they had to liquidate, but they were buying these treasury bonds back when yields were much lower. The yields right now are much higher, so the bonds have been devalued. Hence, the run on the bank has caused bank insolvency, and the FDIC is now in charge. Now, all of us know as well in terms of news, as I just touched upon, as you can see on the screen right now, the short-term interest rates are pretty high right now. I'm showing the 1-year US Treasury right now. It's at 4.871%, but it was even higher just a few days ago. Why are the interest rates so high? The Fed is targeting a pretty high Fed funds rate and is indicating that the Fed funds rate might have to go even higher here to squash inflation. With that backdrop, with all of this terrible stuff going on right now, I wanted to share my outlook for the economy and for my investing strategy, but I also wanted to share with all of you today when I'm analyzing dividend stocks like Clorox, one of the big companies that I own, how I look at the payout ratios and the statement of cash flows. It's really important right now because we could be entering really some tough economic times. The last thing I want to do is invest in dividend companies just to see the dividends get cut. That would be terrible. And quite frankly, that's the background right now because dividends are being cut. I want to talk to you right now about 2 recent dividend cuts. The first one is VF Corp. As you can see on the screen right now, check it out. VF Corp used to be a dividend king. That's right. They had increased their dividend for over 50 years consecutively, but they just decreased their dividend by a staggering 41%. And so dividend cuts can happen. We're starting to see them happen. Another one, by the way, VF Corp, for those that don't know, they make some apparel brands such as Vans and also the North Face, so some really popular apparel brands. One of the stocks many of you in the community are probably more familiar with is Intel. As you can see on the screen right now in front of you, Intel recently cut its dividend by a staggering 66%. And so dividend cuts can happen. It's impossible to avoid them all. During the pandemic-induced market collapse, I actually suffered a few dividend cuts back then in the energy sector, but thankfully the energy sector has largely rebounded right now in 2023. And also because I like to widely diversify, I own 50 different stocks in my dividend stock portfolio. That's right, it's down to 50 now. I did sell one of them as I shared on my Patreon with all my patrons a while back. I like to diversify like crazy because a dividend cut, it can happen. We can't always forecast when they're going to happen, but I will share in the video today how I do like to look at payout ratios and statements of cash flow. But before we keep going, I just want to share an image. As I get ready for each of my dividend investing videos, I like to listen to hip hop music. And as you can see on the screen right now, this is me right here in my Karl Kani outfit. I shared a whole post over on Instagram. I'll link to my Instagram in the pinned comment where I share why I have such a passion for Karl Kani. I don't want to get into all the details right now, but what I love about Karl Kani is he is a quintessential American entrepreneur, and he really built a business out of nothing, from really selling clothing from the trunk of his car into a mega empire. And he, in many ways, embraces the hustle that that comes with being an entrepreneur. And one of the reasons I love hip hop music in general is so many of the hip hop artists, they have that hustle, they have that drive. As we all head into really rough economic times right now, potentially, as is being foreshadowed here by this terrible collapse of Silicon Valley Bank, I think it's important for myself and for the dividend investing community in general to remember our hustle. It's so important to remember that hustle because that is what serves so many of us well during rough times. I actually think dividend investors have an advantage over the rest, I would say, of people, just because so many of us have learned to be scrappy. So many of us have learned to be frugal. So many of us have learned to spend less than we bring in so that the difference can be invested in dividend stocks. I have an exciting video for all of you today. Get ready, everyone, for an exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I want to start out and get into my outlook and then into how I analyze the dividend stocks. And I'm going to get into 5 dividend stocks today. As you can see on the screen right now, I shared some pretty nasty news in the introduction today. And my outlook, honestly, is not that great right now, but I'm happy about it because I'm a dividend investor and I have a multi-decade forever style time horizon. I think we're looking at a decade of slow or no economic growth. I think we're in the recession right now. It is starting. I'm skewing towards current yield right now because I think dividend growth is going to be slow, even though we've seen some recent dividend increases that have been a little bit higher. Quite frankly, I think some of the recent dividend increases, the reason they've been so high is these companies are getting a little ahead of themselves on purpose to keep their yields high so that stock prices stay high because the comparative bond yields are so high. That's just my thesis, however. I'm skewing towards the highest quality companies right now that are least likely to cut their dividends. I am heavily diversified in case of possible dividend cuts. But I faced a few, as I said, during the pandemic crash in the energy sector. Thankfully, the energy sector has come back now, and that's a lesson on its own that the best investing strategy, for me at least, oftentimes is just to set it and forget it and let it all play out over very long periods of time. I'm optimistic, quite frankly, that there could be some buying opportunities ahead, and maybe that's a really good thing for me as a dividend stock investor because when stocks are down, dividend yields are higher, and I'm getting more value for the money that I have invested. And so I want to get into the 5 stocks today. I want to share some stocks that I think are better in terms of their payout ratios and their cash flow statements. And then I want to get into some stocks that are worse off on the list, but I own all 5 of these stocks. In addition to Clorox, I want to talk about PepsiCo. And PepsiCo, I believe, distributes these Frappuccinos from Starbucks. I'm going to include Starbucks, though, on the list as well today. So I got a few of the props, but like I said, who cares about the props when Silicon Valley Bank has failed? There's bigger news out there today, everyone. But anyway, as you can see on the screen right now, I'm just going to summarize the 5 stocks in front of you. And so I'm going from JNJ down to Leggett & Platt. Leggett & Platt is the worst. JNJ, in my opinion, is the best of this particular bunch. And so I have all kinds of metrics here, a few more than I usually include. And JNJ is 18.8% off its 52-week high. I've been actually buying this one. My patrons already know. Check out the pinned comment, by the way, to learn about my Patreon. It's really cool over there. J&J right now actually has a pretty darn great PE ratio. 14s this year, 13s next year in terms of forward PE. Nice starting yield of almost 3% now. What I want to start, though, with on J&J that's so important to realize is the payout ratio is 43%. Of the income, the EPS they're bringing in 2023, they're paying out 43% of that in terms of dividends. Less than half. This is a conservative payout ratio. In rough economic times, when I am concerned about dividend cuts, what I like to look at are payout ratios. The payout ratio is defined, again, as the dividend divided by the earnings per share. Now, I look at the forward earnings per share, the estimate for the year, because I think the analysts, they're typically pretty good, and I get a 43% payout ratio for J&J. Now, different industries carry different payout ratios. Healthcare usually has a payout ratio, or I'd like to see a payout ratio below 50%, but certain industries like sin stocks might have payout ratios up about 80%. It's a different kind of industry. Utilities like regulated electric utilities, their payout ratios might be up there at the sin stocks. It's a different type of industry. So it really varies by industry. But I like to get a flavor of where the payout ratios should be for each of the industries. And then when I analyze a stock in those industries, I like to make sure the payout ratio isn't too high. One example of where the payout ratio is very high, as you see on the screen right now in front of you, is with Clorox and Leggett & Platt. They're over 100%. But I'll get to those in a minute. I want to go through J&J first. And so J&J, the dividend is increasing on average by 6.1% per year. Nice market cap, almost $400 billion. This is really a mutual fund of sorts of the healthcare industry, although they will be spinning off their consumer division later this year. Now, what I show at the bottom of the screen that's different than some of my prior analyses is I have a summary of their cash flows statement. There's two ways to understand if a company can actually afford to pay its dividend. One is the payout ratio. The other way is through looking at the cash flows. And actually right now, J&J, they're the best of the bunch. Surprisingly, even though they're running a negative cash flow, negative $360 million. And I'll tell you why. So 2022 operating cash flow for J&J was about 21.19 billion. The cash flow from investing activities was a negative 12.3 billion. The cash flow from financing activities was a negative $8.8 billion. And the dividends, they typically show up under the financing activities. They also have a small negative cash flow from the effect of the exchange rate. The overall cash flow for J&J right now is a negative $360 million. But the important thing to realize is they repurchased $6 billion worth of shares. And so I include that on the screen as well. If I factor out the share repurchase, the cash flow was actually a positive 5.67 billion. So what that tells me is if J&J decided not to repurchase those shares, they not only had enough money to pay out all their dividends and pay for operating their business and pay for their investments, their capital expenditures, so on and so forth, but they had over $5 billion in cash left over that they could have just stacked on their balance sheet, just stacked in their war chest, so to speak. But instead, they went ahead and they repurchased a ton of shares. Now, repurchasing the shares isn't the worst thing if they're doing it through positive cash flow because it reduces the amount of dividends they have to pay out over time. Fewer shares, less raw dividends. Dividend per share is the same, but each share becomes more valuable in a sense because there's fewer shares outstanding, and it makes their operations, financially speaking, better off. To summarize, I like to look at payout ratio, I like to look at cash flows, and certainly when I factor out the share repurchases, I like to see a very positive cash left over all the way at the bottom of the cash flows statement. This will become more concrete in a minute because I'm actually going to show you what these statements look like. But first, let's go through a few more stocks. As you can see on the screen right now, I don't want to go through all the metrics with Pepsi, but some investors were saying they were disappointed that Pepsi increased the dividend so much recently because they didn't like what their cash flow statement looked like. Anyway, at least what I want to share with Pepsi is their payout ratio. It's a little higher at 69.9%. Pepsi's always ran with a little bit of a higher payout ratio. It's just something I've become a little bit more accustomed to with Pepsi. I would like, though, for a CPG stock like Pepsi to see it a little lower, like say in the 50s or really low 60s. I think up there around 70, payout ratio is too high. I have a thesis, though, that they did increase the dividend so much to keep their overall yield up, because by keeping the yield up around 3%, keeps their stock price up given how high bond yields are right now, because investors are consciously making decisions. Should I hold stocks? Should I hold bonds? Higher the yield is on the dividend stock helps keep the dividend stock value up. That's my thesis, at least. They're increasing the dividend on average per year at a similar clip to JNJ, just a little higher, and it's a $236 billion company. I want to show you the cash flows, though. So they brought in 10.8 operating cash flow. Investing activities took away 2.4 billion. Financing took away a whopping 8.5 billion. A lot of that was dividends. Exchange rates took away 465 million. You're left with a negative cash flow of 607 million on the year of 2022. Now, a lot of investors looked at this. They didn't like it. But if I take out their share repurchases of 1.5 billion, they did run a positive cash flow all the way at the bottom of the cash flow statement of 893 million. Not so bad. I'm okay with it. Let's look at Starbucks, though, really quick. As you can see on the screen right now, here's Starbucks. I'm not going to look at too much other than, hey, payout ratio is 62.4%, a little on the higher end. I'd like to see that up. Down closer to say 50-55%. But I'm seeing this effect now. And this goes back to my prior slide, quite frankly. I think dividend stocks going forward for the next 10 years could have slower dividend growth rates. I think a lot of them got a little ahead of themselves given where our economy is headed. And so I think some of the growth rates could be slower. This is personally why I'm skewing a little bit more towards current yield in my portfolio. I've done a number of videos on this. I'll link to them in the pinned comment. I'm doing this because I want to have a locked in yield versus relying too much on dividend growth, because I think the growth could be a little slower. But as you can see on the screen right now, with Starbucks, payout ratio 62.4%. Thankfully, with Starbucks, it looks really bad on a cash flow basis of minus 3.6 billion when you're all the way at the bottom of the cash flows. But they had a hugely negative financing cash flow in 2022 of minus 5.6 billion on cash flow from financing activities, but a lot of that was share repurchase, 4 billion of shares repurchased. If I factor that out, they ran a positive cash flow at the end of the day of 375 million. I'd like to see it a little bigger. That's why I'm going from best to worst. J&J was the best. Now I'm in the middle of the pack, but let's get back now to the original prop in the video today. But before I do, I'm going to talk about Clorox and Leggett. Clorox and Leggett are both facing a little bit here of cyclicality. They're cyclical in some sense. Clorox was very cyclical around the pandemic. Everyone bought up all of their products, kind of hoarded onto them, got all the wipes for a lifetime of use, and now they're going through their back stock. But once they're through their back stock, they will have to buy the products again, and we're starting to see the tide turn at Clorox and things get back to normal. But they're running a payout ratio over 100% now, and cash flows aren't looking too much better, although they're looking a little better than the payout ratio suggests. That's why I like to look at payout ratio and cash flows when I look at these things. But check it out on the screen right now. With Clorox, the payout ratio is 110%. To be fair, the company is facing some cyclicality, and EPS should come back. And when EPS does come back, the payout ratio will be below 100%. In fact, analysts are expecting $5.38 in earnings for 2024, and they're paying $4.72 in dividends per year. So if this comes to fruition, as soon as next year, 2024, the payout ratio could be below 100%. I believe that Clorox will not face a dividend cut, but I think a dividend cut could be implied by these numbers, but I don't think it's going to happen. Anyway, I think dividend will grow more slowly, but let's look at the cash flows. It's not quite as bad, maybe, as the payout ratio suggests, but let's look at it. Operating cash flow was 786 million. And if I drop all the way, though, to the bottom after I subtract out the cash flow outflows from investing activities, the cash outflows from financing activities, the effective exchange rate, I get a negative 138 million. Not so bad. And they did repurchase some shares, only 25 million. I think they did that to probably counterbalance shares that were issued from probably employee incentives, so on and so forth. They ran a negative 113 million when all is said and done during a pretty rough kind of year, 2022. in terms of kind of cyclicality. And so as far as Clorox goes, it's lower on the list of what I'm analyzing today, but it's a little different than a business like J&J in that it did have that cyclicality. Now, historically speaking, this hasn't been a cyclical business, but it was around the pandemic. But the next one I want to get into where I think there could be a dividend cut, I hope not. I believe this is actually a dividend king, so it would be really sad if Leggett faced a dividend cut because it would be like VF Corp. Oh my goodness, it would be terrible. I've actually been buying a little bit of Leggett recently, not a lot, just for fun, but I like the current yield. I've shared that on my Patreon. You can learn more over there. Check out the pinned comment, by the way, for that. And by the way, if you're enjoying the video, I really appreciate it. Truly, if you could click that like button. Boy, that means a lot to me. Anyway, as you can see on the screen right now, check it out. This is Leggett, and they're running a payout ratio kind of like Clorox at 110%. But what's much worse than Clorox is all the way at the bottom of their cash flows. Even after I factor out the share repurchases, they're still running a negative cash flow of minus 210 million. And this means a lot for this company because this is a small cap. This has a smaller market cap than Clorox. So actually running a negative 210, even if I factor out the share repurchases, that's a pretty big deal for Leggett. Now, worth noting on Leggett, I couldn't get the real kind of full 2022 data yet. So what I did is I took the 9 months ended 9/30/22 and I multiplied by 2. So these numbers might be a little off for Leggett when I look at the cash flows statement, but I did the best that I could with the data that I have. That's the hustle in me, I guess, as a dividend investor. Sometimes I just got to do what I got to do with the particular data that I have. But I think in terms of the 5 dividend stocks covered today, the first 3, the dividend is safe in my humble opinion. The fourth one, Clorox, I think it's reasonably safe. I don't think they're going to cut it, but anything's possible. The fifth one, Leggett, I think it could be a candidate for a dividend cut, but it also is a very cyclical company. And if they can just weather the storm here and get back into the next kind of cyclical upturn, they'll be fine. The problem, though, is I kind of see the next 5 or 10 years as a lull. Are they going to make it 10 years? No. I think the only way they're going to be able to maintain this dividend is if we see the next resurgence in our economy within the next, say, 2 to 3 years. Put in the comments below if you think this economy is going to have a resurgence in the next 2 or 3 years. Boy, I would love that optimism. I'd love to hear it in the comments below. I don't know if it will. I don't think it will, but I hope it will. Hey, maybe if the Fed pivots, if the Fed kind of puts enough runs on the bank and puts enough stress on the banking system, maybe they'll have to pivot. Before I go today, I want to share a few statements of cash flow just so you can see what it looks like. Check it out on the screen right now. The first one I want to share is Johnson & Johnson. This is a pretty special statement of cash flows, in my opinion. I love J&J. It used to be my number 1 favorite stock. Now it's number 2, right behind Starbucks, but I love them both. I love them the same. Anyway, what I wanted to show on the J&J statement of cash flows is just where I was pulling the numbers from the prior screen. You can see net cash flows from operating activities of 21 billion in 2022. You can see it's actually been trending down over time last few years. You can see cash flows used by investing of 12 billion. One of the things I really wanted to point out there is capital expenditures are real. And this doesn't show up in EPS, but you can see here year in and year out additions to property, plant, and equipment, capital expenditures. They're making a lot of them. They're making a lot of them each year, and it looks to be about $4 billion for 2022, so that's a real cost every year. Now, there's also some crazy stuff going on there, it seems, with purchases and sales of investments. That's really interesting, some big moves there. But the most important thing under financing is CapEx. I like to look at that. Under the net cash used by financing activities, you can see the massive 11 billion that is used just for dividends. And this is important for everyone to see here, that basically more than half of the net cash flows from operating activities is right now going right back out the door in dividends. This company cares about shareholders, but it also means that they need to grow the business, maintain the business, certainly not shrink the business to keep growing their dividend. The other thing I want to share is all the way at the bottom, you can see decrease or increase in cash and cash equivalents, and that's where you see minus 360 million. And you can see why that happened this year with these negative outflows. But worth mentioning, they purchased $6 billion of their own common stock. And so that's really important to mention as well. That's why the whole thing toggled negative. And so that's J&J. Let's look at Pepsi really quick. Check it out on the screen right now. This one's going to come through in 2 screenshots. The first one, as you can see, is showing operating activities of $10.8 billion in 22. The next one shows investing activities. It was a negative $2.4 billion. Again, I want to show capital spending. It's big, it's consistent, CapEx is real. This doesn't show up in EPS because payout ratio is based on EPS. So I like to look at payout ratio, but I also like to look at cash flows because cash flows really tells me if they can afford to pay the dividends. But anyway, that was the first screenshot. I want to show you the next screenshot, though, with Pepsi. Check it out on the screen right now. The next screenshot shows the financing activities. And you can see here on financing activities, they paid a huge $6.1 billion in dividends, and they had a net cash used by financing of $8.5 billion. We drop all the way to the bottom, and they see a net decrease in cash and cash equivalents of $607 million. But again, if I factor out the share repurchases, that would swing positive. And so now you've seen 2 of those cash flow statements. And I think the biggest takeaways from the video today is there's some wacky stuff going on right now with interest rates. It's placing a lot of stress on the banking system. And the next few years might be rocky. It's good to be a dividend investor, in my humble opinion, because when times get rough, I enjoy relying on my dividends and I enjoy reinvesting my dividends. I enjoy deploying new cash so I can get more yield for my overall portfolio. Remember, when share prices go down, starting yields go up. And so for an investor like myself who only invest for cash flow, I don't really care about capital appreciation as much. Sometimes a rough few years can be a good thing. But if it gets too rough, that's also not a good thing because dividend cuts are possible. We've already seen it with VF Corp and Intel. And the analysis today shows how I look, or I kind of understand if a particular stock might be exposed to a possible dividend cut. But before we go, if you go to the comments below, I would love for you to put in the comments which stocks you think in your portfolio or just in the dividend community might be ready to face a possible dividend cut. Never good news, but let's get it out there and see what the community thinks. I love you all. If you enjoyed the video, please don't forget to subscribe with that notification bell. It means the world. I look forward to seeing you in the comments. Before I go, in terms of a full disclosure, I do own the stocks mentioned today. I'm long Clorox, CLX, Starbucks, SBUX, PepsiCo, PEP, Johnson & Johnson, JNJ, and Leggett & Platt, LEG. I own all of those stocks in my personal dividend stock portfolio. Before I go today, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. I'm not sharing any financial advice, just my personal journey for fun and entertainment. I love you all. I'll see you in the comments below, and I'll see you in the next dividend stock investing video.